price of gold is already kind of smelling some sort of a yield curve control. Gold has been in this great moderation, has been something like the bad guy in wrestling. Yeah. And now there's this heel turn. So gold is in central bank spheres is becoming the good guy with, I think on average 26% allocation by the central banks.
You told me in our last interview that the great moderation is over. We might be in for another leg up in inflation. I'm guessing then if you hold the same view, you don't think this inflation is transitory? Ronald-Peter Stoeferle joins us today. He is the founder of the famous In Gold We Trust report. We'll be talking about his latest findings from the latest report. He is also the partner of Incrementum AG, and he's on the board of Tudor Gold. And I'm very excited to get his outlook of not just the precious metals, but how the economy is going to progress and drive the precious metals and Bitcoin over the next few years. Welcome back to the show. Always good to see you in person, Ronald.
Good to see you, David.
We're here at the beautiful Beaver Creek Conference. Sentiment here is very high right now compared to maybe a few years ago. But even the gold price, you said to me offline, surprised you at how fast it moved. So we'll talk about your outlook in this interview and your outlook on Bitcoin as well. I want to start by current economic data. Just today, we're speaking today on Thursday, the 11th of September. This week, the CPI came in hotter than expected, 2.9% headline CPI. In the US, that's up from 2.7% the month before, which is up even further from the month before. So that's 3 months of a trend of higher inflation print. Where's this headed from here?
If we sum it up, it's basically a stagflationary environment, that we're now facing. Jay Powell, if you listen to him closely in Jackson Hole, I think he was really emphasizing the upside risks that he's seeing in inflation. And then on the other hand, having a look at jobs report, but also economic data, sentiment, it seems that the US economy is cooling off. And I think that the price of gold kind of enjoys seeing the Federal Reserve being, between a rock and a hard place, because there's an enormous amount of pressure on Jay Powell, obviously. But then on the other hand, inflation numbers are going in that direction where actually they'll have a hard time aggressively lowering interest rates, and I've read some rumors. Dave Servos from Jefferies, who usually has a really good take on markets, he's now talking about 75 basis points cut. So I think the price of gold is also, if you have a look at the 75 basis points. If you have a look at the long end of the curve, I think the price of gold is already kind of smelling some sort of a yield curve control, some sort of a next round of quantitative easing coming up. And that's a pretty good setup, I would say.
You told me in our last interview that the great moderation is over. We might be in for another leg up in inflation. I'm guessing then if you hold the same view, you don't think this inflation is transitory?
No, I think we're seeing another inflation wave basically building, and that obviously is the last thing that central banks want to see now. From my point of view, it is pretty obvious if we compare it, and there's a couple of great charts comparing the inflationary waves of the 1970s, for example, to the current wave. It looks pretty similar, although it's also some sort of chart crime happening sometimes. But then I think to some degree inflation is also a psychological thing. I would say it's not only a monetary thing, and I can tell you from my experience here, we're getting used to high inflation, because here 3 years ago, a steak for like $60-70, I thought, okay, that's very high. Now I think, okay, gotta live with it. So I think that we are in the Western world, we're now getting more and more used to structurally higher inflation numbers, a little bit like in emerging markets. And therefore, I think that another inflationary wave is definitely a possibility that the market still seems to neglect.
Morgan Stanley's chief U.S. economist said, in short, ignore where inflation is today and ease policy to support the labor market in regards to what the Fed is going to do next. The labor market is showing signs of weakening. Just today on the 11th, jobs numbers, initial claims came in at the highest in 4 years, meaning more people are filing for initial claims. And last week, the BLS revised down by 911,000 jobs in the 12 months ending March 2025. So definitely cracks. So now the Fed potentially has to deal with higher inflation and, like you said, a stagflationary environment.
But they will probably come up with a new wording or whatever. I mean, I think it was interesting that they stopped this average inflation targeting that they introduced a while ago, where basically said as inflation numbers were too low for a certain period of time, they said, okay, we can let it overshoot, but now as inflation numbers were way too high, they would have to let it undershoot. But now they said, okay, let's forget about average inflation targeting, just stop doing that. So I think when you know what hits the fan, they become pretty creative with like new models, new terms, new abbreviations. And yeah, so
ultimately, markets and how assets will react to fiscal and monetary policy into the last inning of 2025. This boom that we've seen in gold and Bitcoin and stocks, moving all three together, it's interesting. Maybe first describe or explain why all three have moved together so dramatically in 2025 to new all-time highs, and then give your overall thesis for what's next.
Yeah, well, I just checked the numbers. Compared to 1 year ago at the conference, gold was trading at 2,400.
Yeah.
Silver was, I think, 28, 29. The S&P was like 5,600. Bitcoin was 55,000.
Yeah.
So pretty decent performance in, let's say, sound money, kind of real assets. But if you have a look at bond markets, obviously, I mean, that's where the trouble is. And my take has always been gold isn't the enemy of equity markets. Yeah. So I can clearly see, let's say, stable or higher equity markets and a positive environment for gold. I think the real potential is coming from fixed income, where we, as mentioned, seeing this complacency when it comes to inflation, because we've seen this great moderation. Basically, inflation was the least concern for asset allocators for 40 years. And now we are in this new inflationary paradigm where, let's say, not high inflation, but rather high inflation volatility is one of the primary concerns for constructing a portfolio. So from my point of view, if you have a look at equity markets, I mean, we've seen Oracle just recently coming out and the stock was up 30% on the data. Then we're seeing that Nvidia now has a higher market cap than the GDP of Germany. So all those things are obviously signs that the US tech isn't cheap anymore. However, if we have a look at in our portfolios, for example, we're still seeing very, very attractive valuations in the value space in Europe, in emerging markets, in commodity space. I think we're very, very active in the oil space at the moment. So I wouldn't say that per se the equity markets are super overvalued. It's just those, obviously those Mag 7 stocks that everybody is so crazy about that. Yeah. Clearly is in a bubble, but in general, I would say equity valuations are still, at least in the markets that we follow, at reasonable valuations. Yeah.
You have a 8,900 target for gold in the next couple of years by 2030, I believe. This was in your research from in Gold We Trust. Are you moving that number at all, given that gold has run up faster than you expected in the short term?
No, I mean, I have to slightly correct you. We have, in 2020, we came out and said it's going to be a golden decade. People were ridiculing us, and we presented our incrementum gold price model, where we said gold has to be, there has to be a monetary valuation of gold. Obviously, it's pretty hard to value gold, but we're doing it based on our monetary factors. And we said in our base case scenario, conservative scenario, our price target is $4,800 by the end of this decade, so 2030. And we're clearly above that interim target. That would be, I think, 2,900 by the end of this year. But we also have an alternative scenario where we say if inflation will be one of the main drivers for market in this decade, then up to $8,900 is actually possible. Now, 8,900 sounds like a big number, but that's actually a 19% CAGR from here until 2030. Now gold is up 40% year to date. It was up, I think, 27% last year.
Yes.
So is 19% CAGR until 2030, is it impossible? I would say no. But still, David, I think the most important thing is gold is in a bull market. And we've seen this big breakout from this consolidation phase, 2020 to 2024. And now we are like in a new stage of a bull market where every little dip is being bought. So that means that there's a tremendous amount of capital waiting on the sidelines. So many people, so many asset allocators that completely missed the gold party. And that's the reason why those corrections are so shallow.
Yeah, well, people have been concerned about whether or not gold's momentum will sustain right now. People are asking me and other people, should we take profits right now? Actually, you're calling this the Hautaka moment for gold. Can you explain that analogy?
Yeah. I'm always coming up with sports analogies, yeah. Because I think you have to create a narrative, and I think this storytelling is important because we're all, how much data can you actually, process? Yeah. So I think it's coming up with analogies, with pictures is an important thing. Last year we had the analogy from the world of professional wrestling with the heel turn, where I said that gold has been in this great moderation, has been something like the bad guy in wrestling. Yeah. And now there's this heel turn. So gold is in central bank spheres is becoming the good guy with, I think on average 26% allocation by the central banks, the highest in 30 years. Now this year, and this was also the title of the In Gold We Trust report this year, we said it's the big long, meaning that in the first half of this decade, we saw gold developing very, very well. However, we saw that silver, mining stocks, and also commodities were underperforming gold. And now we are in this new stage of a bull market where silver, gold, and silver mining stocks really start outperforming gold. And this usually happens like in the second half of a bull market, let's say like in the third part or the third part of the uptrend of the bull market. And this is what we're exactly seeing now. If you have a look at relative charts, we can see that silver starts outperforming gold, although the gold-silver ratio is still at ridiculous levels at, 88? But we're seeing that finally the mining stocks start outperforming gold, with the GDX being up, I think, almost 100% year to date. And we're seeing that slowly but surely that commodities also are picking up some momentum. So we compare it to the Tour de France, where you've got, if you ride in the peloton, you've got the guy in front, faces, of course, the most, is taking the most, wind, so that the wind pressure is the highest, and if you go in the middle of the peloton, you save energy. Right. But now gold has been kind of the guy at the front, but now it's the time for those sprinters picking up momentum. They have saved energy, and this is what we call the Hautaka moment, which is a part of the Tour de France. And I showed a video of Tadej Pogačar, who's like the superstar of cycling now, where he, on his really a ridiculous way up, very, very steep up, he just picks up momentum, and sets the pace, with an enormous amount of power. And this is what we're seeing now in what we call performance gold. So silver, gold stocks, and silver stocks finally starting to outperform gold.
You have three primary drivers of gold for the golden decade, if you want to call it that. Have your drivers changed this year versus last year?
Not really. I would say the foundation of this bull market, and that was the topic of last year's In Gold We Trust report, the new gold playbook. We said the foundation of the bull market is this enormous, structurally growing demand from emerging markets. So not only China and India, but also Turkey, the Arabic markets, they are just becoming more and more important. And perhaps in the Western world, we're a little bit ignorant when it comes to this enormous amount of demand. So this is still, I would say, my base case, this kind of love trade for gold. But then we're seeing three additional drivers, which is first of all central bank demand. We are on track to see more than 1,000 tons of gold central bank purchasing for the fourth year in a row. So that's significant demand. And this will continue based on the World Gold Council survey. The second driver, from my point of view, is this kind of erosion of trust that we're seeing. So if you have a look at, for example, COMEX deliverers, it seems that people now really want to get the real stuff instead of paper contracts, and we're seeing this trust erosion, in so many pockets of our lives, be it in science, in politics, in the media, and also in institutions, and also in, I would say, like the gold market, where people say, okay, well, if it gets tougher, I really want to have the physical gold and not a paper contract. So that's the second trend. And the third trend that we're seeing is obviously this kind of de-dollarization, which has been a major driver going on, with basically the world breaking apart into two blocks. And just recently we saw this Shanghai Cooperation Organization meeting, and if you look at the symbolic character of those pictures with Xi Jinping, with Modi, and with Vladimir Putin, it seems that they're pretty good friends, and that they will try everything to kind of, build an alternative system. So gold is a neutral, non-inflatable reserve asset, and I think it always held that role basically, but now it's really celebrating a renaissance.
Okay, well, do you think that Bitcoin's narrative also has similar drivers of gold?
Yes, I mean, it's, we are running two funds that combine gold and Bitcoin. So we are in both camps. We're in the sound money camp. I just can tell you, bless you.
Thank you.
That, the sentiment in the Bitcoin space is, it doesn't feel like that we're very close to new all-time highs, actually. Yeah, it's kind of a neutral sentiment.
Right.
Yeah, which is a very positive setup from my point of view. So I think there's still way to go. I think that the combination of gold and Bitcoin is now something that's resonating more broadly. We launched the first fund more than 5 years ago. Now we saw Cantor Fitzgerald coming out with a gold Bitcoin product. There was Tether Gold. I had a very interesting conversation yesterday.
Right.
So I think more and more people are realizing that the combination makes sense. And I also know from many people, let's say younger people in the Bitcoin industry, the older, you're a young man, but the older you get, the more conservative you become. And I know many Bitcoin millionaires, perhaps even billionaires, yeah. The older they get, the more conservative they become, and the more interesting gold becomes for them, because perhaps they don't want to deal with this enormous amount of volatility in Bitcoin anymore. So I think it's really now going both directions, from gold to Bitcoin, but also from Bitcoin to gold.
You have time for one final question. Which do you think will be the outperformer next year, Bitcoin versus gold, if you had to choose one in 2026?
Volatility adjusted?
No, just nominal terms.
It's a tough one. Silver.
Silver. Okay. You're a politician. I like that.
That was an insight.
I
never go into politics.
Well, okay, $40 silver, so we're looking at 45, 46, potentially 50?
Triple digits at some point.
Yes.
Yeah, within this bull market of gold.
Where can we follow you, Ronald?
On our webpage, ingoldwetrust.report. You can download all our reports. Incrementum.li is our company homepage for our investment solutions, and then I'm pretty active on Twitter or on X.
Yes.
So yeah.
I encourage everyone to check out the In Gold We Trust report. We don't have time to go over all 300 pages, but it's
400.
400. I'm sorry, it gets bigger every year. But yes, it's very comprehensive, very educational, and very thorough. So check that out. Thank you very much, Ronald. A pleasure as always.
Thank you.
Thank you for watching. Don't forget to like and subscribe.